Please do allow me to introduce Toni-Ann Neita-Elliott. She's the Vice President of Sales and Marketing at Sterling. Despite her youthful appearance, Toni-Ann has 20 years of experience in the financial industry. She joined Sterling in 2015 as an Assistant Vice President, and in 2020 was promoted to Vice President. In this capacity, she leads the sales and marketing team and is responsible for strengthening client relationships, ensuring a high standard of service delivery, growing assets under management, and building the brand. Prior to joining Sterling, Toni-Ann had a successful stint at Citibank, where she rotated through the FX, securities trading, and money market desks, and also at JPS, where she managed a portfolio of the company's largest corporate clients. Ladies and gentlemen, please join me in welcoming Toni-Ann Neita-Elliott to the podium.
Usual height issues. Let's figure this out. All right, good morning again, everybody. And thank you, Marion, for that introduction. And thank you to our guests for coming out, because we know it's not always easy, especially if you're not a morning person, to come out this early. But we thank you for starting your morning off with us. And thank you to Bruce, for he had the hard job of starting off this morning and leading us off. And he made what could have been a very intense and not so exciting topic. He made it very interesting, we have to admit, and very easy to digest. So he's made my job that much easier, because you guys are now awake and alert and excited to learn about 3 common mistakes to avoid in estate planning. These are actually based on hard lessons that our clients have learned, their friends, their family, and that even we, the Sterling team, have learned over the years. Now, I hope you can see this. So this is a very interesting statistic, and the aim of it is to really drive home why investment management of your estate should matter to you. Now, this is based on a 20-year research project on 3,200 families by a US-based wealth consultancy firm, Williams Group. And their research basically showed that 70% of wealthy families have lost their wealth by the 2nd generation and 90% by the 3rd generation. Now let's really sit and absorb these statistics, right? Because this means that basically by the 3rd generation, most families have lost their wealth. So much for this whole buzzword of building generational wealth, right? Does anybody have any idea what could be possible reasons for the loss of wealth, this crisis that we're seeing? Okay, that's definitely possibly one. And I promise Christine didn't see the presentation before, so she's not cheating. But in the essence of time, I'm just going to move on. So the reasons for the loss of wealth, based on the studies: poor investment management. There's an increasing number of beneficiaries with each passing generation, because of course if you have 4 children and then each of those 4 children have 2 children, that's 8 children by the next generation. And then of course we have the ever-present problem of inflation and increased costs. Now, effective investment management helps to ensure that the wealth that you've accumulated over a lifetime is not just preserved, but it also grows at a rate that beats inflation. This will allow you to pass a larger estate on to an increasing number of beneficiaries across those generations. So today's presentation is going to focus on the importance of investment management in estate planning and the 3 common mistakes to avoid. Now, the first mistake is choosing bad assets. The assets you choose will affect how easily and how much of your wealth you can transfer to the next generation. So, just basically, of course, your estate is made up of assets, and the value of that estate is going to be tied to the assets it contains. So naturally, if you have high value assets and profitable investments, these can significantly increase the value of your estate. But if you have low value or depreciating assets, that can diminish its value. Therefore, having the right assets is critical. Now, when choosing these assets, there are a number of things to consider, but the two main things I'm going to discuss today are liquidity and the quality of the assets. Now, what is liquidity? I know a lot of times, we're in finance, so we throw around this word very often, and we think it's like an obvious term, but I decided to explain it today. Liquidity refers to the ease of conversion of an asset to cash, right? So if you have the assets in your estate, whether they're liquid or not liquid, that can impact your estate's practical value. If you can't sell the assets, then obviously, if you can't sell them and you can't sell them quickly and easily, then you can't distribute them to your beneficiaries, you can't settle debts, and you can't meet the financial obligations of the estate, for example, taxes. So here we have a liquidity spectrum showing you the most liquid assets, with cash obviously being the most liquid. Then we have bonds, and then you go to the other extreme where you have the least liquid assets or illiquid assets, which are luxury goods and real estate. I noticed in Bruce's example of John that I noticed that a lot of his assets were tied up in very illiquid assets. He had a lot of luxury goods and real estate, which we'll actually touch on later. But even within these asset classes, there are degrees of liquidity. So for example, within bonds, you have some bonds are more liquid than others. Sterling specializes in global US dollar bonds, which you'll find are more liquid than local bonds. And you'll find a similar problem if you have international stocks versus local stocks, with the international stocks being easier to liquidate typically than local stocks. And then even within real estate, you'll typically find that residential property will be more liquid than commercial property. Now, in terms of the quality of the financial assets in your estate, the quality is very important for several reasons, because it will determine how much you leave to your beneficiaries. Now, typically high quality assets will tend to appreciate over time and or provide stable income streams. So that's going to, of course, maximize the value of your estate and ensure that your beneficiaries receive the greatest possible benefit from your legacy. And also now you'll also find that high quality assets are usually easier to transfer or sell. So we're right back to this whole issue of liquidity, where it's very crucial to be able to liquidate those assets so that you can cover things like taxes and debts and other expenses related to your real estate. So just by having high quality assets in your estate, it makes the distribution process smoother and easier for your heirs. And finally, quality assets contribute to the overall financial stability and security of your estate. They ensure that the estate can sustain itself and support the beneficiaries over the long term. Because if you have assets or investments in your estate that don't perform well or they default, then obviously you'll have less to leave your beneficiaries. Sterling's analysis and advice has helped our clients to avoid bond defaults. I think everybody has heard about the Digicel and the government of Barbados, and there's another popular one that we don't have there, but Credito Real. Now, this is just more, I guess, like a specific example of a very specific product. How many people have heard the term repo or repurchase agreement or have ever invested in it? Okay, good. So as I said, it's a fairly popular investment. It's a short-term investment. It's offered by many institutions. But the truth is, a lot of people don't realize that not every repo is created equal. And the reason for that is that all repos are secured or collateralized by a bond, right? So the quality of that collateral is going to be important and should be important when you're considering who you should get your repurchase agreement from. So just to backtrack, since everybody didn't raise their hand, just to say how a repo works. It's a short-term investment, and an investor basically places cash with the broker. We see the diagram there. And although you don't even really realize what is happening is that the broker is providing a bond to you as collateral. They're not actually giving you the bond, but the bond continues to be owned by the broker and it's pledged to the investor. And that collateral, as I said, is basically safeguarding your investment in the event that the broker is not able to repay you at the maturity of the repo. And then at maturity of the repo, you get back your principal plus the promised interest. So I hope in just that simple explanation you can understand that if this collateral, this bond, is what is securing your investment, why it's important, the quality of that collateral is important, because you'll be left with a claim on an asset that's essentially worthless. So Sterling uses high quality global bonds to back or collateralize our repos, making them much safer than the government of Jamaica collateralized repos that are offered by other local institutions. Now I know people hear government and they think safe, but again, just like I said, all repos are not created equal, all governments are not created equal, and every government is still rated. They have what we call a credit rating, and so they're not all governments are rated A, like in school if you do well. So the government of Jamaica is actually not very high up on the credit quality scale, and so by us using bonds issued by corporations which have a higher credit quality than government of Jamaica, we are offering, as I said, a much safer short-term investment option. Now, mistake number 2, this one always gets reactions. Okay. All right, so this, you people can still hear me? Okay. All right, so mistake number 2. This one always gets a lot of reactions from our audience, but this is overexposure to real estate. And that's because real estate, as we know, is a very popular asset in Jamaica in particular. In that people invest in it because they know they not can just get income from it, but they also get capital gains. But the mistake is that many investors are over-invested in real estate. And on top of that, they tend to overestimate the real returns by ignoring the associated hidden costs of owning real estate. Normally you just think about the purchase price, you think about the appreciation in the price over time, and you look at the monthly rental income, but you ignore the maintenance costs, legal fees, taxes, etc. So to get an idea of the return on real estate in Jamaica, what can be earned from real estate, last year, in fact, exactly 1 year ago, we did an exercise in June last year where we looked at some popular real estate funds to kind of get an idea of what you can earn on real estate in Jamaica. And these are professionally managed funds. They buy, they sell, they rent real estate, right? So you'd imagine that they're the professionals, they know what they're doing. The first 3 bars show the returns on those funds, and as you can see, it's probably not as exciting as you think it would be. And then in comparison to the last bar, the bar on the furthest right, the 9%, that actually represents the yield that you could have earned on a global US dollar investment grade BBB bond at the time, which of course is 28% higher if you do the math than the net operating income on these funds. And that's without hassle. And why do I say without hassle? Even everybody who's even a proponent of real estate in the room, I'm sure can admit that real estate ownership does come with certain challenges. So on top of overestimating what you can be earning on your real estate, a lot of people ignore the challenges or the hassle, as I said, that comes with owning the real estate. So, for example, if you own real estate as a rental property, you know that the income stream is not always consistent. You're going to have periods of time where the property is vacant. You're going to have possibly, even worse, delinquent tenants, right? we did a planning a retirement planning presentation recently to the Western Health Regional Authority, and one of the attendees shared an instance or a situation where they had invested in 3 rental properties for their retirement income, and 2 of those properties the tenants had not paid rent in a couple months, I think it was that she had said. So we know this is a very real challenge. And then you have to think about too, if you're purchasing the real estate and your intention is to pass it on to your children, not only are they inheriting the property, but they're inheriting these listed challenges as well. So we talked about delinquent tenants. You can have the whole issue of rising maintenance costs. You have repairs and other planned expenses. And of course, you have property taxes. And this can be even harder for them to navigate if they live overseas, which, as you know, is a trend we've been experiencing for a very long time, and I don't think it's going away anytime soon. And then you have another situation where you pass and then your elderly spouse or your aging spouse inherits that property. Are they physically able to manage dealing with delinquent tenants and complaints and repairs? Can they afford the costs associated with owning that property? And even if they can, do they want to? And that means they would have to hire expensive management services, which of course would cut into the income. So what would you do then, or what can you do? What is an alternative to real estate? Bonds work like real estate, but with much less hassle. And if you remember from the liquidity spectrum earlier, bonds are also far more liquid than real estate. So how a bond works is that you buy a bond, there's no legal fees, no stamp duty, no transfer tax, and that deal closes in 2 days, or if Judy was here, she probably would correct me, and that's now moved to 1 day, and that compares to and that compares to 3 months, which is the typical turnaround time for a real estate transaction. And then you now own that bond, you enjoy fixed scheduled interest payments from the issue of the bond throughout the life of the bond. And that's similar to enjoying rental payments, right? So you skip the whole lease agreement, you don't have to worry about the risk of the tenants not paying, you don't have any maintenance fees, you just have a certain regular income stream, and you know exactly what you're getting and when. And the beauty is you can lock in that income stream for a very long period of time, because you can buy a 10-year bond, a 20-year bond, a 30-year bond. You are very, very unlikely to be able to consistently rent a property for that length of time. You're not going to get anybody who is going to want to sign that length of a lease usually, and not necessarily going to consistently have tenants for that entire period of time. And then at the end of the life, without any kind of hoopla or anything, automatically you receive back your principal at the end when the bond matures, or it's called, again, no hassle, again, you skip any further legal work, you don't have a lengthy sales process, and no taxes or any fees associated with that transfer of funds. And then another way that bonds are less hassle then is because you can transfer bonds to the next generation very easily. So if you have a portfolio, investment portfolio with Sterling, and you hold bonds in that portfolio, and you have your beneficiaries as your joint holders, once you pass, the ownership of that portfolio, everything in that portfolio, including the bonds, automatically and immediately passes to your joint holders. No legal fees, no transfer tax, and no waiting for the will to be probated, and no dispute or any accident in terms of what you had intended to be the case once you pass. But as Bruce says, it doesn't matter when you're gone. But if you want to make life easy for your beneficiaries, that's definitely something you can consider. Now, Sterling, now that I've gotten you interested in this whole concept of bonds, I hope, just to give you a little background quickly, Sterling specializes in global US dollar bonds. You can buy and own those bonds through us and your financial advisors. We have them here with you. I'll introduce them to you later. They will help you to select the bonds that meet your risk profile and return objectives. They're best suited for investors that want medium to long-term investments and whose primary objective is income generation. But what many people don't realize is that bonds also offer the opportunity for capital gains. You can buy a bond at a particular price and sell it for a higher price in the future. And if you buy a bond at what we call a discount, when it matures, you receive more than you paid for it at maturity, even though you didn't pay that for it. So you have a built-in capital gain right there. So just to say that because bonds give you both options, you get both interest and capital gains, you can earn double-digit returns from bonds. So we have a little graphic there just to depict that we pulled a snapshot out of a specific client's portfolio, and that client had 2 bonds that had double-digit returns in there, and that again is just a combination of the income and the capital gains. Now, if capital gains, though, is what really excites you, we do also offer a US dollar mutual fund. A mutual fund is a pooled investment. It can be invested in anything, invested in real estate, in equities. But of course, if you guessed it, our own is invested in bonds. We have a diversified mix of high-quality US dollar global bonds that make up that portfolio. And as an investor, you'll own a share of the portfolio and you'll benefit from the fund's performance. Now, the graph on the right is showing you if you had US 100,000 invested in the fund at inception in 2003, that US 100,000 was worth almost 804,000 in March of this year, and it's worth even more now, which is more than an 800% growth, which is about an average of 10.5% per year. And the units in that fund, you can encash those, you can sell your units and get the cash in 10 business days. So again, it's another example of a more liquid asset than real estate. All right, so mistake number 3. This is miscategorization by a financial institution. Now, basically, this one is speaking, I would say, more specifically to trust and how important it is for trustees to work with financial institutions who have a clear understanding of trusts and their operations, so that your beneficiaries can avoid facing some very common inconveniences. We ourselves have seen and heard the complaints from our clients, so we know you can have delays in accessing your funds. If the institution doesn't recognize the trust authority and the legal validity of the trust documents, then you can have prolonged periods where your beneficiaries just can't receive their inheritance. And then on the other extreme of that, the account can actually just be frozen, where they don't want to give you access to the funds at all because they're not satisfied with the legitimacy and the authority of the trust. And then if the financial institution requires extensive documentation or legal proof that the trust is valid and the trustee has authority, it can result in additional legal and administrative costs. And then again, lack of understanding by an investment manager can result in errors in management and communication and distribution of the trust assets. You can have incomplete or incorrect execution of the trust terms, and that can result in financial loss or dispute among the beneficiaries. And then mismanagement continued again, that can lead to the loss of the potential tax benefits that trusts are designed to provide. And if you don't work with a responsive and experienced investment manager, that can prevent you or cause you to miss out on market opportunities, because they should be ensuring that your assets are appropriately invested at all times. Now, who doesn't like... Well, let me get into some takeaways first. So the key takeaways this evening in terms of for successful estate planning, just to summarize: focus on liquid, high-quality assets. Don't be overexposed to any particular asset class, and include U.S. financial investments in your estate, because it's important to have an optimal asset mix. And finally, you want to partner with a financial institution that understands trusts and how they operate. Now, everybody loves a freebie, so we've actually added a bonus mistake in here that I want to share with you this morning. Mistake number 4. Not knowing Sterling Asset Management. So those of you who don't know, because we do have some of our clients here, but for the past 23 years, Sterling Asset Management has provided investors with a source of profitable U.S. investments to grow their wealth over the medium to long term, but we also offer attractive short-term rates as well. We were actually the first in Jamaica to offer global U.S. dollar bonds to local individual investors. I just realized I haven't switched the slide. But we have a very strong balance sheet. We have retained earnings of over $8 billion, and we have a capital adequacy ratio of 33%. I'm going to just pause a moment to explain that briefly, because it is a measure that you should be familiar with and bear in mind when you're trying to choose the financial institution you do business with. So capital adequacy is just basically a measure of a financial institution's strength. The purpose being to ensure that the financial institution has a certain amount of capital, enough capital to handle a certain amount of losses before being at risk of becoming insolvent. The higher an institution's capital adequacy ratio is, the more likely they are able to withstand financial downturn or other unforeseen losses. Now, so just by itself, 33% probably doesn't sound very high if you're thinking 100% to be the max, but the Financial Services Commission, the regulator for the industry, only requires financial institutions to maintain a capital adequacy of 10%. So in very simplistic terms, this means that we're over 3 times safer than an institution that just maintains the regulatory minimum. And then finally, we have assets under management of $67 billion. Now, our board of directors consists of a group of well-respected and experienced professionals, including our two independent directors. One, we have a former managing partner at PricewaterhouseCoopers, Maxim Rochester, who couldn't be here today. And then we have a former vice president at Citibank, which is actually where I know him from, turned lawyer, Robert Taylor, who flew in from Florida to be here with us today. It also happens to be his birthday. So just wishing Robert happy birthday, and we're really grateful that you're spending your birthday with us. And as Marion mentioned, this is actually Robert's idea, so I'm sure he's glad to see the idea come to fruition. I know the board, and then of course we have Marion and Charles are here with us today as our executive directors, and our board keeps us accountable, and Marion always says, you know, they make sure to ask us the hard questions and just really keep us thinking and at the cutting edge and staying ahead. So this was one of the ideas that I know definitely came out of it, and I'm sure they'll dissect it in the next board meeting. KPMG has been our external auditor for over 20 years. They sign off on our financial statements, verifying that our financial records are an accurate reflection of our position. And then we have PricewaterhouseCoopers as our internal auditor. They test and verify the effectiveness of our controls and procedures. Now, you've heard me mention just a few of the products that we offer. You've heard us mention today 3 specific investment products. I mentioned US dollar global bonds, I mentioned US dollar repos, and I mentioned our US dollar mutual fund. So this is really just a summary of the key features and benefits of those 3 products. Not really intended to go through it today, but we do have members of our team here, so you can feel free to stay back if you have the time and ask us about these products and other products we offer. If you have to run, you know, please feel free to take our contact information and call and email us, because we are definitely looking forward to hearing from you. So we have our members of our sales team here this evening, you have myself, and you have the rest of the team, so feel free to stay back and ask us questions.
Thanks so much, Toni-Ann. So I have the pleasure of telling everyone thank you and goodbye and allowing you to go about your day. Again, we really appreciate your time this morning. I think unlike money, you can't get back the time once it's spent. So hopefully everybody learned something here today. And if you have any questions, just reach out to whoever invited you and we'll put you in contact with the right person. Thank you, everybody. Thanks very much, Michelle Valentine from Sterling, the Sterling team, and Pegasus for hosting us this morning.